Welcome back to Curious Commerce, Capital Budgeting Series, Part 11. Imagine you invest 10 lakh rupees in a project. You earn returns for 5 years. But here is the real question. What happens at the end? Does the project suddenly stop? Does cash flow become zero? Or is there a final hidden return? Think like a business owner. Would you just walk away without taking anything back? This final return is what separates average students from the smart finance thinkers. In real business, projects are not infinite. Every project has a lifespan. For example, a company buy a machine for 5 years. After 5 years, what happens? Machine is sold, inventory is cleared, cash is recovered. This recovery is called terminal cash flow. Most learners ignore this, but companies never ignore this. Always we should consider the cash flows. Let's define it simply. Terminal cash flow means final cash inflow received at the end of the project. Generally comes at last year only, not repeated in nature. It is one time inflow. This is not profit, this is actual cash coming back. When you sell your old bike, that resale money is your terminal cash flow. Terminal cash flow is not one single thing. It has three important components. First one is salvage value. Second one is the working capital recovery. The last one is tax effect or the tax impact. Remember this formula in your mind. Final return equals asset value plus working capital plus tax effect. Once again, I will repeat. Remember this formula in your mind. Final return equals asset value plus working capital plus tax effect. First component is the salvage value, means resale value of asset or scrap value at the end of the lifespan. For example, you bought a machine for 5 lakh. After 5 years, you sell it for rupees 50,000. That 50,000 rupees we called as in the salvage value. This salvage value we should consider at the end of the lifespan of the machinery. This is extra cash coming at the end of the lifespan. Even your old phone resale is salvage value, right? Component is the working capital recovery. When business ends, what happens to inventory? The sold maybe takes place, cash collected, automatically the receivables clear. For example, you invested 1 lakh rupees in stock. At the end, you sell everything. That 1 lakh comes back. Working capital is temporary, it always comes back. Learners forget this, but it is guaranteed recovery. Always working capital is temporary, it always comes back. The third component is very important component, that is tax impact. When you sell asset, you may have profit or loss. Selling price is greater than the book value, it leads to the profit. Automatically you should pay the tax. That is the first scenario. Once again, I will repeat. The first scenario is selling price is greater than the book value. When the selling price is greater than the book value, automatically it leads to the profit. When the profit is received, automatically it is taxable income. That's why it is you should pay the tax. The second scenario is selling price is lesser than the book value. When the selling price is lesser than the book value, automatically it leads to the loss. When the loss takes place, automatically it gives the tax savings. For example, book value is 40,000 rupees, sold at 50,000 rupees. It leads to the profit of 10,000 rupees. You should pay the tax for the 10,000 rupees. But the book value of the machinery is 40, but sold it for 30,000 rupees. That is the loss of 10,000 rupees. It gives the tax saving. Tax can reduce or increase your final cash flow. Smart finance always considers tax. Let's combine everything. First one is the salvage value, second one is the working capital recovery, and the third one is the tax impact. Let's combine everything. For example, the salvage value of 50,000 rupees, working capital of 1 lakh rupees. The total terminal cash flow is 1,50,000 rupees. Did we earn this during operations? No, right? This comes only at the end. This is why last year cash flow is always higher. Why should we care, or why we should give the importance for that? Majorly, we consider the three powerful reasons. First one is affect the total return. Second one is the used in NPV and IRR, the net present value and IRR, that is the capital budgeting techniques. Third one is often ignored. Even a good project can look bad if you ignore terminal cash flows. Many learners lose marks here, many investors lose money here. We should consider the terminal cash flows at the end of the lifespan of the machinery or the project. As a manager, he or she never ignores the end. He never ignores the terminal cash flows. Always they're focusing on the real cash, and they targeted the full recovery and accurate estimation. The real manager's view towards a company always profit is the opinion, cash is the reality. Therefore, a smart manager think about the end from the beginning. He always think as a smart. Think always about the end from the beginning only. Let's quickly revise what we discussed today. Terminal cash flow means the final cash inflow. It includes salvage value, working capital, and tax impact. Can you now calculate the terminal cash flow? Is it possible? A small amount today can change your project result significantly. That's why we should consider the terminal cash flow at the end of each and every project or the machinery. Video, we will discuss about the depreciation impact on cash flow. You will learn how depreciation creates hidden cash flows. If you want to master finance, stay with Curious Commerce. If you want to study pure finance, the realistic finance, follow Curious Commerce, like, share, and subscribe. Once again, thank you all.